Hey everyone, welcome back to Corporate Decoder. Today we're diving into 89bio's latest financial report. It's a bit like opening a treasure chest hoping for gold, but sometimes finding, well, more paperwork than pirate booty. Let's see what story these numbers tell us about their journey to fight liver and heart diseases. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below if you'd like to discuss more. This report covers their performance up to March of this year. 89bio is a company trying to create new medicines, especially for liver and heart problems. Their main hope is something called pegozafermin, which they are testing for MASH, a serious liver illness, and for SHTG, which is very high levels of fat in the blood. Like many companies trying to discover new medicines, 89bio is losing money, and they've lost quite a bit. The report says they have an accumulated deficit of almost $900 million. That's a big number. Now, how are they paying for everything? Well, let's scroll down to their assets. They have a lot of cash to spend to do research, about $315 million plus another $323 million in what they call marketable securities or short-term investments. So a total of over $600 million in cash, which is great. Now let's look at how they are spending money to develop their potential medicines. Let's scroll down to their income statement tekken. They spent about $64 million on research and development in the last 3 months, compared to $47 million last year. That means they are working harder to discover medicines. They also spent about $11 million on general and administrative expenses, which is expected to increase. All this spending leads to a loss, or net loss to be precise. For the last 3 months, it was $71 million, which is more than the $51 million they lost last year. But don't panic, all this spending on research has to happen if you want to discover medicines. This net loss translates into a loss of 0.49 cents per share. And it means if you own a stock, you would own 49 cents less than the other years. Let's pick on what impacts the cash flow. The report says that they have a big negative 71 million cash flow, which matches to the loss. Again, no surprises here. It means they are spending more money than what they are getting. Again, expected for a R&D shop. Luckily, they can raise more cash by selling stocks. It proceeds from issuance of common stock, which means selling their stocks. This led to raise more than 269 million. This is what offset the expenses. That's why their total cash went up. Now let's move on from the numbers to see some of the what ifs that might impact the company. Scroll to fair value measurements. This section talks about how the company estimates the value of their assets. For example, they have something called warrant liability, a financial responsibility which can fluctuate in value. It is difficult to estimate these, so they have to do it each quarter. They record income tax expenses for their foreign operations, just like any multinational corporations. Here we see more about future risks, in particular their agreement with Teva Pharmaceutical Industries. If their drug succeeds, they need to pay Teva a chunk of money. Also in April of last year, 89bio signed collaboration agreement with Bibo Biopharma Engineering. 89bio is committed to give 135-year-old Bilrymia fat implant for their potential medicine. To get additional money besides selling stocks, they have a term loan facility. It's a fancy way of saying they borrowed some money, and if they fail to comply, their assets will be seized, except IP, and some additional restrictions may apply. A company will keep shares of common stock to issue to employee future grants and more. We can now focus on the risk factors. This is a very important section, so pay extra attention. The company is upfront about how risky their business is, since discovering medicines is never easy and involves plenty of science. A very common phrase, the company reminds us that it has no drugs to sell. All revenue, it relies on clinicals. The business's success depends on one potential drug. That's not good. We call that having all eggs in one basket in finance. They say they might need to raise more money down the road, sell stock debt, etc. This depends on how pegozafermin goes. They also talk about potential delays in trials. They rely on third-party manufacturers, which can have all sorts of issues. If the contract manufacturers can't produce the drug on time, it could also delay, harm the trials, and cause a mess of problems. This facility in China could also have the same issues. There are also risks with the drug itself, maybe has side effects that were previously unknown, or maybe the medicine just ends up being ineffective. It also notes that developing a new medicine to treat this liver disease, MASH, might take longer than expected. What if the drug is effective but not better than the competition? Also, the government regulations for approval can change, which is also a big risk. They are warning us to not believe the initial numbers on new data in trials, because they may change once we dig deeper. What about risks with all the debt financings? Well, their loan agreement can restrict them from taking certain actions which could harm the operations. What if they default? That would cause everything to be due instantly. That would not be good. There is also risks that some current stockholders sell big portions of their stock. They may not even be able to use some past losses to reduce the taxable income, which would not be ideal. The war in Ukraine, China's relationship with other governments, US, and many others may have a negative impact and cause delays. That's because regulations outside of the US are completely different. Also, there is a chance to not get all the IP protections they would get in America. Of course, as a company dealing with human trials, there is always a lawsuit risk. There is also always risk of fraud, wrongdoing from employees and vendors. Cyber attacks are more prevalent now than ever. This poses a great risk. Our amended and restated Certificate of Incorporation provides that the Court of Chancery of the State of Delaware, last the markets themselves may affect its operations. War in Ukraine, Israel, etc. So, what's the story here? 89bio is burning cash to find a blockbuster drug, and pegozafermin is their best bet. But the road ahead is full of challenges, and their business could be greatly affected if any of these materialize. Now, let's put on our Warren Buffett hats and make some assessment. On the plus side, they have a strong cash position of over $600 million, thanks to stock sales. This buys them time to continue research. It is also worth mentioning that there are no big revenue to offset the costs yet, so it is pretty standard. Alright, that's our breakdown of 89bio's latest filing. Given the tough path forward for pharmaceutical companies and a concentrated product line of only one, it's clear we need to see pegozafermin succeed for investors to truly win. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into the world of corporate filings. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.